and welcome to our How to Fund Growth Without Sacrificing Stability webinar. I'm your host today, Adam Farag, Vice President of Strategic Markets at Oak Street Funding. Joining me today is Matt Reynolds, President of Thurston Capital. Today we're going to discuss owners often misjudge the balance between growth and stability, which investments tend to deliver a real return, how lenders evaluate risk differently when growth is on the table, and more. Matt, thank you for being here today.
Thanks for the invite.
So let's kick things off. Really, from your experience, where do advisors most commonly misjudge the trade-off between financing growth and maintaining stability?
Sure. As we were talking about before, the biggest difference or the biggest struggle that we see is there's a huge difference between access to capital and absorbing capital, right? What we find is, lenders want to lend, investors today want to invest, valuations that are all-time high. A lot of times that is misconstrued as I have the right plan and the right things in place to do it, right? So that's where we're seeing the biggest kind of offset. Capital markets, they're pricing opportunity, as you guys are well aware, right? It's not really risk adjusted in a lot of cases. It's what could happen. I think the other is everybody hears this nomenclature, right? EBITDA and pref, and it sounds really cool, but the truth is cash flow is king. That's what matters.
Absolutely. Makes a ton of sense. I couldn't agree more. As a debt provider here for advisors, first and foremost, that's what we're going to evaluate before enterprise value is, what does the debt structure look like? And as a senior debt provider, do we have a structured amortization schedule and loan term that can be paid back adequately with cash flow? And I know that's a little bit different than the equity side, but
right.
I think there's a ton of different types of capital in this space, and, understanding which one suits you best is important as you evaluate your strategy here. So, when firms are exploring like different opportunities they have, like what signals about the firms tell you that they're ready to take on capital as an equity investment or something like that?
Sure. And I think we can probably both have some of those things, right? Some of it is preference in our experience, but a lot of times when people are ready, the number one thing is typically they have a clear description of who they are, what their business is, and what their business isn't, right? They're able to tell that story, and they know that they already have a business that they can expand. And it's probably, especially in the lending side, I would imagine, that's the big one, right? Can you continually grow as is?
Yes.
The other is just a well thought out plan for growth. I think, and I'm sure you guys get this too, how are you going to spend the money is one of those questions you have to ask. And there needs to be a clear, this is how we plan on implementing or using the cash. And I think probably the most important is they're already used to reporting, right? So that financial transparency, I'm sure you guys get it all the time, right? Why do I have to give you that on a monthly basis or on a quarterly basis?
Oh yeah,
right,
for sure.
And it isn't just because I want to control something. It's because we need to understand. We need to help you course correct. In some cases, and at the end of the day, the best relationships are made with those firms that want some sort of input, some sort of help along with capital.
Agree. So I wrote down a couple of things as you were saying that struck a chord with me, and one of the things I wrote down was pouring gas on the fire. Yeah. Right. So. Yeah. When you think about capital in this space, for me, when we're making a loan, I want to see something that somebody's doing really well, and adding leverage to that is going to help them grow exponentially. And so we're moving in the right direction. Another thing you touched on was how important the use of capital is. And I think a lot of times in our industry, because multiples have grown so much and because enterprise values have gone up so much, a lot of folks' net worths are tied up. A lot of owners' net worth are tied up in these businesses, and they want to capitalize on that and take some chips off the table. And that's an okay strategy. You have to pair that strategy with the right capital partner, right? Because I think if you want to borrow to grow, to your point, we've got to understand that use of capital, and we got to make sure that aligns with what you've done, what you're trying to do, to make sure that we're all using it to end up in a spot that we all want to be in as a lender and as a firm and everything else. So with that, what signals raise concern or might suggest that a firm is not prepared for an equity investment or financing or something to that effect?
Yeah, and it's really all the opposite of what we just talked about.
Right?
Right?
Yeah.
So you have especially in those organizations where there's partners,
Mm-hmm.
the disparity in what the story is or is going to be, right? You can, and again, I'm sure as you talk to different people, there's going to be one advisor or one partner, right, who wants to build through growth because right now acquisitions are hot and easy way to expand revenue and assets. There's going to be another one who might be more conservative and says, look, if we can just add this many people, we can do this better. But to your point, it's that interviewing and understanding what they're looking for. So that partner conflict in a lot of cases is what we look for first, right?
Yes.
Why don't you guys get it straight first and then tell us what you want?
Right.
And then I think the how they pursue growth is probably the biggest one we see because again, there's that disparity, right? They know that growth can equal a couple of things, but they don't have a well-defined thought on how to. I don't have a problem, and in fact, I think it's great when advisors say, "Hey, look, I have a plan, but I'm also going to be opportunistic."
Right.
That makes sense to all of us.
It does.
But it's when there's not a clear delineation of here's first and foremost how we're going to grow and add to what we currently do. Right?
Correct.
That's the big thing.
That's what we're underwriting too.
Yeah.
We're looking at loans, and when you guys are looking at investments, I mean, that's what we're looking at is, who's this firm going to be? What are they growing into? And how much can we help them do that? One of the things that I think about when doing loans to advisors that are growing is if they're looking for capital, are they using that capital to run away from something that's not going well?
Right.
Or are they running towards something and leaning into something that they're already doing very well? Right. As a specialty lender in this space, that's our job is to bridge that gap, between traditional banking that doesn't necessarily understand the space and the uses of capital, or, private credit, private equity that really does. We're kind of that middle bridge. And I think there's a lot of firms in that space that are going to take capital for maybe the first time.
Yeah.
Right.
Yeah.
And so one of the things that I like to evaluate is, when I'm looking at the use of this capital, are you trying to solve a problem that your firm has created, or are you really leaning into, something that you're already doing very well and growing? So that's big on our side too.
And I know we'll get into it further, but a big part of that, who are you going to invest in, right? When you guys make that determination, has got to be, all right, you're running a business, and that's what we want to underwrite is your current business and to help it grow.
Yeah.
The other thing is when there's this huge difference between this is the business that we have successful needs gasoline, as you said, right? To grow it. And then but now we want to do something completely different that we haven't done before, but we believe it's our fastest way to grow. That's where between education or just a conversation with the advisors to help them understand that's really what we're doing is we're focusing on your core business. Everything else has to be kind of opportunistic.
For sure. And I think you also have to understand too, when doing on the debt side, we've got to understand the global plans because it's not all one thing, right? We've got G2 buying out G1 in some cases. And one of the things that I look at in those situations is, are you going to take on so much debt here that you're going to sacrifice the title of our webinar here? 100%. We were going to sacrifice, capital and free cash flow that you could be using to continue doing things that you do really well because you have to buy out a shareholder, and that's going to eat up, your cash flow. So how do those deals get structured the right way where you can do both? And that's a lot of what we evaluate. So, when we're looking at different growth initiatives, which ones tend to deliver the strongest return, when they're financed, and which ones disappoint?
So the easy answer is, all right, the ones that have the greatest opportunity are the ones where there's built-in opportunity for either acquisitions or through internally funding some growth strategies, right? Okay. Just stick with what you know, right? But let's go ahead and add to that. The other is succession planning. I think those are the built-in, what you're getting, and there's really strategic ways to help both of them. When we look at those types of opportunities, that's an easy conversation to have. Everyone knows what they're doing, and really there's no big changes that have to happen other than from a perspective or capital perspective. Where we really see the ones that fail, and again, I'd love to hear this from a lending perspective where you guys see it, but from an investment standpoint, it's the untested growth, right? So I'm an advisor who has great organic growth, which is the number one indicator for us.
Technical,
yeah. And immediately there's this, if I have money, I can go ahead and I'm going to go out and I'm going to buy all of these worst case related entities, but not in our business, right? So you'll see a lot of advisors who say, well, now I want to get into the technology and I want to get into these other things.
Yep.
And unfortunately that isn't where they live every day, right?
Correct.
So even if they get really good at that, they're giving up on the business that's gotten them to where they're going. Those are probably the biggest ones. You guys, you probably see this too. There's always this belief that growth for growth by itself makes sense. And in a lot of cases it doesn't, because it doesn't help the margins or anything else.
Yeah. I think in our industry, you can be a specialist in wealth management in so many different things.
Yeah.
So one of the things that our founder says that I like to say is we like to be an inch wide and a mile deep, right? So if I think about some of our clients that are experts with Microsoft executives or experts with Boeing employees or experts in aviation or whatever, like those guys really understand that sector and how to grow it and understand what they need to grow that. So to your point, I think, there's a lot of noise of, hey, let's diversify into tech or let's diversify over here. And we always have to challenge that, especially on the debt side, because it's not a spec thing. It's looking at cash flow. And then we're asking that very question that we're talking about here, which is, well, how much are you going to sacrifice in what you're currently doing well to step into this? One of the common ones on the advisor side is buying CPA firms.
Yeah,
right.
We hear that all the time.
So super common. And there's folks that do it really well and folks that don't. And I think to everything that we talked about even before this started, there's opportunities to diversify in like a mini multifamily office feel and provide, a number of different services outside of wealth management to continue to grow your current client base. And that's great. But you can kind of put a little bit too much energy and focus into something like that, and it can really derail what you're doing really well.
Yeah.
So, that's a common thing we see too.
Well, and it's funny. So, I mean, we're clients of Oak Street, right? We've got a great relationship. Our business.
Yep.
We have a accounting and tax practice that lives inside our business.
Mm-hmm.
In a lot of ways, that was strategic from a standpoint of, as advisors say that, right? Because we hear that too. We were looking for capital because we're looking for an investment because we want to go out and buy a CPA firm.
Right.
Are you CPAs? No. Have you ever done a tax return? No. But I know that there's value there. So, in a lot of cases, we've found that it's just a good way for us to say, look, if that's something that interests you, great. We can work out the economics. That's the benefit. Let our internal group manage that process or manage the acquisition of that.
Yep.
And just become part of the greater.
Yeah.
Because again, it's in a lot of cases, it's interesting for people to take on those new roles or strategies.
Yep.
In all honesty, what they do really, really well is what they do with their clients in most cases.
No, and it's funny that we bring that scenario up. We're closing a deal for a client that's, primarily an advisor client of ours that's larger, and they're buying a CPA from this is their second one that we've helped them with. These guys do a great job of integrating and bringing all that business together very quickly, right? So I think that's a big part of it too, is they have a seller who was younger, who wanted to stay around, who was entrepreneurial, that saw the value add, the 1 + 1 = 3. And they're like, yeah, let's do this. So I think that's important too. If you're just getting into something new, are you built for that? Are you hiring the right people that are going to run that? And so you can continue focusing on your business. So.
And we don't, in a lot of cases when we're doing this, you talked about cash flow. We talk about cash flow.
Mm-hmm.
We're a pretty simple firm. Right. It's really all about what everyone takes home at the end of the day.
Mm-hmm.
But you're right. One of the things that a lot of advisors miss is, especially when they get into some of these disparate areas, is the investment that you have to make to make sure that you can scale. And unfortunately, that doesn't perform real well.
Right.
That's not a.
It's a loss leader for a minute. Yeah.
Right. And I think the idea that you have to be upfront with whomever you're taking capital from. We're going to, I love the term J curve. Because it explains like, I'm going to lose money and then we'll do okay.
Yeah.
Right. From where I stand, let's be honest up front and let's talk about what we need to invest in your firm first before the growth.
Absolutely. And when you say the J curve, I'm going to come right back with the K curve. So I've heard this before and I use it quite a bit, and it kind of relates to anything, but today we're talking about taking on capital.
Right.
When folks take on capital, I think it's a K. You either see some folks take it and go right up, and other folks take it and go right down for the same capital investment. So it's all about, like you said, understanding the firm, understanding their plan and making sure that who you're taking capital from, you really align with.
Yeah, 100%. So, all right, we've talked about the fact that there's, we're talking capital, there's lending, there's equity, there's convertible debt, there's all kinds of things, right?
Yes.
Every flavor out there. So, as a bank first, right, specialty, but as a bank first, how do you guys help advisors when you think about leverage so it helps growth as opposed to hindering cash flow and putting them at risk?
Yeah, great question. So, I think first and foremost, got to understand the strategy with capital. Like we've talked about before, the use of the funds is key, right? And so I would say target senior debt leverage is 3 to 4 turns of EBITDA. And, as we've said on a number of these things before, the target might be much less than that. So let's talk about the use of capital for like a dividend recap, which we've done, where folks say, hey, I've got to take some chips off the table. I've invested a lot of my own capital into this business. It's thriving. It's cash flowing. I want to pay myself back. My target for senior debt leverage is going to be much lower than if they said, hey, I want to take this capital and invest it in that $5 million I'm going to borrow from you is going to create $10, $20 million of enterprise value. Yeah. And here's how, right? That might have a much higher leverage target because of who they're going to acquire or what they're going to do with the capital. Let's say it's an acquisition. There might be a tremendous amount of synergies and added on cash flow that you get immediately that's paying for the debt itself, right? So if we see that strategy, it's like, we can go a little bit higher on senior debt, right? But if you're just taking capital out and these are two very extreme situations, there's probably a middle ground too, but heavy growth, maybe some high and a lot of room enterprise value wise with the firm and a loan to value perspective, we'll go a little bit higher on senior leverage. Not as heavy growth, not as much investment into organic or inorganic growth, just taking capital off the table, maybe a little bit more of a lifestyle practice, but good enterprise value. Might make sense for senior debt, might be 2 to 3 turns of EBITDA instead of 5, right?
How do you make that determination though early, right? Is it through, does someone have to come to you with a business plan of something like that? Or do they come to you with an idea? How do you help them figure that out?
So it's both, right? I mean, we've been doing this for a while and I like to think that we take a very consultative lending approach. So some folks come to us with an idea, right? And they say, hey, this is what I'm thinking. You guys have been doing this for a long time. What do you think about that? And how can we structure a loan to execute something like that? And that's one side. Then you'll get other folks that come to us straight with a deck that say, hey, we've been thinking about this for a long time. We're working with a consultant. We're working with folks that have helped us tailor the solution. This is exactly what we need. Here's how we're going to execute it. Do you have some time to meet on it? And maybe it's a little bit less consultative for us. And it's, hey, this makes sense. And we can fund that. Usually it's something between those two. Usually it's not one extreme or the other. Usually there's a general idea of what they're going to do and everything else. But I think it's seeking to understand and early on really listening and trying to understand what the plan is. Because there's just a number of different uses of capital in this space, whether it's recapitalizing owners, funding inorganic or organic growth. What's the use of capital? And from there, we're going to work backwards to see what's the right, debt solution for you.
We get a lot of questions about how you're going to work with me in the future, right? So yeah, there's the economics and there's the structure. And obviously that has to be figured out. But so it's from the equity side, right? From the investment side, we want to have that close conversation, right? So if you've got a great idea, bring it.
Yeah.
We can assess it and we can see if we can actually add to it.
Yeah.
But from a banking perspective, where I always think of you guys having to figure out, okay, yes, growth is great, but at the end of the day, how do I get paid back?
Right.
How do you guys get consultative during that period, right? So how do you maintain not only a banking relationship, but how do you get consultative with an advisor kind of throughout the relationship, right? Because the relationship you have, like us, is over a period of time.
Yep.
How do you help them?
So believe it or not, a lot of that starts with challenging them.
Okay.
And I'm thinking about that as you're talking through it. And when I think about some of our best clients and relationships, a lot of it isn't just like an order taking, hey, I need $6 million and this is what I need. And we say, okay, cash flow pays for it. And we move on. A lot of times there's a little bit of a push and pull for us because we're going to stress test, their plans. based on things that we've seen, right? We've done this for a long time. We have a good sized portfolio of these types of loans. So we've seen the ones that have gone good and bad and the reasons they've gone good and bad. And I think the more experience that we get working with those firms and the more years we're in this space, the better equipped our staff is to really triage some of this stuff up front and say, all right, this is going to be a fit because of this or not because of this. But I think it's really coaching. And believe it or not, a lot of wealth advisors are really receptive to that. Although there's some push and pull because they may not get exactly what they want, but they got what we know is the best thing for the organization and for a debt relationship. So it's trying to balance that, I think, is making sure that we're providing them what they're looking for to grow, but also challenging them every step of the way on, why do you think this is a good idea? Like, all right, you want to do this acquisition, you're paying a little bit higher of a multiple. What are we going to do to the structure of the deal to make it make more sense? Or, maybe you're going to pay a lower multiple, they need more cash up front. Like, we're going to dig into that. Mm-hmm. I think that's a big part of being a specialty lender within a bank is understanding the space enough to know where to press. When I say where to press, like you think about going to the doctor, it's like they're pressing to see where's it hurt, where's it hurt. And as an organization that has a tremendous amount of experience in this industry, I think we know where to press. And that brings out the right conversations to have that consultative discussion with a client and ultimately land in the best spot with a loan, hopefully.
Yeah. We talk about stress testing, forecasting.
Yeah.
Right. So, when we look at that, and I think this is something that you were just referring to, but a lot of times we'll have all right, let's just talk about how we got to that number. Mm-hmm. Right. And of course, the advisors who have put everything into their business mm-hmm. want to know that their valuation of their firm, of their blood, sweat, and tears is the highest it can be. It's funny, though. We find that the advisors who have stress tested, they come to us with an idea. They come mm-hmm. to us and they understand what a valuation might be. Mm-hmm. The ones that we're willing to actually give a higher multiple to are those that come to us and say, I've stress tested this. I know in a down market, right? Mm-hmm. Or I know what may happen here, and I know that we can afford X, right? That's from a lending perspective. That's from an investment perspective. But those are core concepts for us. Yeah. And if an advisor doesn't quite understand that, we try and take a step back and say, all right, we're going to play devil's advocate. You talk about, pushing back to them. I call it being a devil's advocate. What happens if? Yeah. What happens if the comp drops low enough that you have to take a discount to make sure that the equity numbers or the lending numbers hit?
Yes.
If they can look us in the face and say, I've thought about it, I'll have to do this, we'll have to do that. That's a big one. Yeah. I think that's probably where we see then the overestimation mm-hmm. of adding this much money creates this much growth.
Yes.
And not building in the fact that you have to have infrastructure to do it.
Yeah, the thing that I'll add to that on the lending side for the banking piece is really in the advisor world, like stepping in and saying, what's the difference between EBITDA and EBOC? And for those, EBITDA, earnings for depreciation, interest, tax, amortization. EBOC is earnings before owner's comp, right? So a lot of times as lenders, especially with, a firm with only 2 or 3 owners or a sole prop firm, we have to bifurcate those two things and say, what is EBOC? So what's your margin on the business that the owner group's taking home that's inclusive of their distributions, but also they're above the bottom line W-2 pay or whatever. Yep. And then when I have that EBOC number, we have to normalize their compensation to figure out how much do they need to live on. So to touch on your point there, what can they go to in a if they lose 20% of the revenue? How low can they take their personal comp so that we can understand the true cash flow of the business? So that's an exercise that we walk folks through that they don't even realize. We're doing stress tests right here to figure out, let's start with all the cash that the owners are taking, and then what can they take, right? So that we have that, there's a gap there usually.
Yeah.
Right. And we've got to understand that gap when doing a loan.
Yeah.
So what financing decisions have you seen help firms grow quickly in the short term, but then might create some challenges later on?
So the biggest one is just about everything.
Okay.
is based on earnings or EBITDA, right? And
Okay.
I've said before, right? EBITDA, you got to kind of ignore that. It's based on earnings, right? So advisors have put their entire life into building a practice, and they've made this huge decision to take on capital.
Right.
What they want is they want the greatest amount of multiple for that.
Mm-hmm.
The struggle with that is like lending, right? We expect a certain percentage return.
Correct.
That's the difference, right? You guys have a hard dollar interest rate. We have a return rate.
Yep.
And we're happy to do some of that as long as we have structure inside that protects our investment number.
Okay.
And I think a lot of advisors realize pretty quickly, unfortunately, it's usually too late to make a change, that yes, I had the best year ever. We hit all these numbers. It's being, my return's being calculated on a net revenue or EBOC. And for that, I'm going to take an X multiple and I'm going to get a lot of cash.
Right.
The struggle is in the future, right? Because advisory fees and recurring fees don't mean, it's resistant to downside, right?
Right.
They typically find that the what needs to happen on a year-over-year basis extracts a toll from them because they have to focus on making sure that they hit those numbers, or they have to they have to pay that back, and it takes away from their ability just to do what they enjoy doing, which is talking to the clients and things like that.
Yes, taking capital isn't the finish line.
Exactly.
And I think you said it really well there. We're just getting started working together, and there's expectations for you. It's on the growth side and hitting certain investment revenue that you guys are making in the firm. For us, it's covenants, right? Cash flow covenants, and not over distributing cash flow to owners, or, having an appropriate cash flow to pay the business back, and having an appropriate gross revenue margin. I mean, there's a number of covenants that we put into place. So I think, understanding that when you take capital, whether it's for, from a bank for debt from us, or it's equity from you guys or something like that, ultimately that's the beginning of the relationship. It's not the finish line where, unless you're ultimately just selling the business and moving on. Yeah. So I think that's important.
The structure helps too, right? So if you guys, I know that covenants are one thing, obviously working with you guys, you try and, as new opportunities hit, let's reassess what you've got in place. Yeah. From our standpoint, it's when we do a structure with someone, we try, and if we can't get there, right? I believe it's worth an X and you believe it's worth a Y. In a lot of cases, what we'll do is we'll say, let's just do it for a year, right? Let's do based on my math for a year. And if we get to your math after that, we'll go back, we'll restructure, and we'll get you paid out.
I want to take that and do it on loans too. Right. Hey, listen, we'll do it your way on the covenants.
But if it doesn't work out,
then we get to change. So for everybody listening, hopefully some Oak Street credit folks, maybe we'll start doing that. Yeah. That's a joke. But all right. So uncertain market environments, right? Directly correlated with the industry that we work in. How do you advise firms to structure these deals so that they can retain flexibility, as conditions change when they get into a deal with Thurston?
Yeah. And I think I'll take it from the equity side. You take it from the lending side, because I think it's equally as important. Generally when we're doing leverage, or we're doing a deal for purposes of internal investment, meaning they're making a decision to have a succession plan. So we're basically funding the next buyer, right? Something like that. They have to be in a position to say, I know what my value is worth. I'd like to get X, but I know that it's a range, right? Because it's a range depending on the investor, right? Depending on the lending. They just have to be ready for the big difference, which is the higher the multiple, the more involvement anyone's going to have with us, anyone else. And exactly. It's mostly, it's funny, it's usually looked at as, all right, we've all heard the stories about PE walking in and making decisions.
Right.
I think in a lot of cases where we look at it from is we're operators first.
Okay.
Let's see how we can help you actually get to that number.
Yeah.
Right. I mean, I don't think anyone ever wants to do a deal where I'm hopeful that I get to pay you the least amount as opposed to the maximum amount. Right. Yeah. I mean, none of us want that.
Right.
But leveraging someone who's going to come in and say, all right, open up the books. Let's see how you're operating. And here are some tweaks that we believe can help you get to that higher number.
Yep.
And that's a struggle, I think, for anyone who's listening, right? Optionality is probably more important than the final number.
Got it.
At least for investing, because I know from a lending perspective, it's a little bit more difficult. It's easier for us to say we'll do it around a structure. We'll be more liberal with how we structure those options and the triggers.
Yes.
But you have to come in understanding that you have a certain responsibility too.
So the thesis is the same. The levers are a little bit different on the debt side, right? So a couple of things that I wrote down while you were walking through the equity side. On the debt side, I still think that you need a diverse capital strategy, especially as it relates to a succession plan, right? So think about you have a 100% owner and you have 4 employees that want to buy out the 100% owner. I think there's got to be some portion of that that's financed from a debt vehicle like us that's a very structured 10 to 15 year AM, based on cash flow. And I also think there needs to be a subordinate seller note or earnout, associated with that as well. So one of the ways that I think that you diversify that capital strategy and that you protect yourself in a downside or give yourself more optionality is by structuring a soft note with the seller. I'll give you an example that we're in right now. $25 million enterprise value business. 4 internal employees are going to borrow 10 from us. There's going to be another 15 that they owe one seller. That $15 million seller note is structured with a lot of flexibility. There is no fixed maturity date or fixed amortization. It is what we would call a soft note, meaning that they pay us as a senior lender, first, right? Then there's profitability after they pay us. They are going to owe the seller a certain percentage of that profitability until the seller is made whole. So what does that mean? A couple of things there. First and foremost, in the event there's a downside, our buyers are heavily protected in their cash flow because the more the market goes down and the more the cash flow goes down, the less they owe the seller right now. Not to say that they're not going to owe them eventually, but the less they owe them right now. As there's also risk in the upside. And we've financed some of these before too, where they might have a deal that they're paying 75% of the excess cash flow out to the seller. Well, if they grow really fast and that hyper amortizes, they may not want all that capital to go out the door to the seller.
Right.
So I've had folks actually come refinance one of those with us because they're like, we don't want to pay the seller off 50% right now, and use all that cash flow. We'd rather restructure that with you on senior debt and cash flow it with you so that we have more access to capital to invest in other things. So long-winded way of saying, I think that having a diversified capital strategy, whether it relates to equity or debt, I think is important. And structuring deals that have the ability to protect you in the event there's a downside, or hyper, advance it in the event there's an upside too. I think it's important. So that's one of the situations that we did on the debt side.
Yeah, I think the unintended consequences are the things that most advisors or most people looking for capital, they can't quite comprehend, right? So what you just explained, I would look at that and I'd say having to hyperpay, right? Because you have a higher cash flow number,
right?
Makes it difficult because you've grown too quickly. We all know the biggest problem is that infrastructure. Right. So when we talk to people, it's, what's your biggest concern, right, about our business model? Biggest concern is you're growing too quickly and not absorbing the extra revenue well.
And that's defining that line too of how do you draw that line to make sure that you're appropriately investing in infrastructure and growth while continuing to fuel that growth as well.
Yep. Agreed.
You mentioned forecasting and stress testing, so we'll kind of move past that one. But how does evaluating risk for growth financing differ from refinancing or maintenance capital?
Maintenance capital. I think we all agree. Like, I don't want anyone taking out a loan or trying to get equity just to be able to put more into expenses.
Yeah,
that's the struggle. Refinancing makes sense, right? Yes. So, evaluating risk for growth financing versus just refinancing. We'll look at growth has the greatest upside opportunity.
Right.
Business owners need to remember that's also the greatest risk, right?
Correct.
Because you might be able to double your revenue, but now you have execution risk, you have compliance risk, you have all of those things that go into an acquisition.
Yep.
And I think a lot of business owners forget that the business of that transaction is a business unto itself, right? Just managing that transition and that equation. The refinancing is not as exciting because really all you're doing is trying to figure out, a succession plan.
Right.
But what we found is that is probably your safest money.
Okay.
You have a built-in G2 who's now committing to equity. I think those are, again, the slowest growing. There's not the same type of trajectory from upside, but it's probably the safest money because there's a transition timeline and they've already know the business.
Yeah. It's like the slowest moving investments, your safest money. And it's
the same for you, right? I mean, the difference is, yes, you might give an additional multiple on the upside if you have a plan or business plan for growth.
Right.
But hey, man, if it's just we're refinancing so that we can buy out, the patriarch or the matriarch, that's good business.
Yeah.
Right. And that makes a lot of sense.
Yeah. No, I think it's great business. It's a significant portion. It's grown for us year over year since probably 2017, the internal G2 financing. For us, it really, a lot of it, the math is easy when you get to an internal succession plan. We're not synergizing anything. We're not, integrating anything. A lot of times the folks that are buying out the senior shareholders or the majority shareholders are folks that are running and operating the business already.
Yeah.
Right. So the math part, I think, works a little bit easier. What I focus on in the succession deals are, what do the roles and responsibilities look like post-close? What do they look like today and what do they look like post-close? How's that going to impact the clients? Is there hiring you're going to have to do? It's really more in the business operations and the capital strategy when I'm looking at succession plans. And then I push on the 100% buyouts too, right? Like, what type of disruption is this going to create?
Yeah.
Right. It's one of those things where it's either all the way on this side or all the way on this side. I like stuff in the middle. Right. So, I think that makes a lot of sense. What financial indicators do you encourage owners to monitor closely to make sure growth financing is actually strengthening the firm and not just increasing risk? So kind of hand in hand with what we just talked about, but what do you monitor there?
It's funny because that's exactly what we were just talking about. So the number one indicator for us is organic growth historically, right? So that could be, it's not just about, hey, how quickly have I grown, but it is the maturity of that. Right. So, and same thing you guys look at, right? I want to make sure that there's not we just got a single client that now represents 25% of our revenue. That's a different approach.
Right.
But true historic growth, diversified business plan, diversified type of client, geographic diversification, all of those things. If you see that consistently, it doesn't have to be, we hear about Cager. I've been hearing Cager a lot. We're not talking about a growth rate that is in the double and triple digits.
Right.
Man, we have grown every single year, and it has been a great kind of allocation across all the different business lines. That's the number one thing for us.
Right.
Right. Again, that then inures back to, what are we really investing in? Well, we're investing in growing that business.
Right.
So that's the number one thing. I mean, it defines brand strength, right? It also defines kind of the advisor productivity, because they've figured out how to have their structure so that they can acquire more clients and still provide them the same amount of service. I think the other one is capital. We've talked about kind of the upside, downside of capital. Capital in and of itself is not good or bad.
Right.
It's really, what we look at is how it's going to define the behavior going forward.
Correct.
So if people have a plan, if they, as we talked about, right, they have a plan, they've operated a great business, they want to grow this current business, they want to grow a business line that's tangential but part of what they do, you can kind of count on that, right? Because you've seen the experience.
Right.
The struggle is, and I'm sure it's the same for you guys, depending on the structure of the deal or how an advisor takes the money we're investing, it's going to define what they want to do, right? So if it's all based on cash flow, then they're going to be tempted to cut expenses in lieu of high service. Right? If it's based on outcome, then they might be willing to go out and try and acquire new clients while reducing their costs. Not good for anybody, but it allows them to get to the higher gross revenue. So we want to know that the indicator is the growth, and they have a built-in idea of how they want to grow from here.
Got it. And I agree with that. The only thing that I would add is, as it relates to an acquisition or some inorganic growth, when folks are seeking bank financing or financing for an acquisition like that, the deal structure is every bit as important as the valuation, if not more. Yeah. There's an old adage that, I'll pay you whatever valuation you want, but you're not going to like the structure. Right. So, and, I think the structure of the levers that you pull that truly defines your capital strategy and your cash flow within the organization. So one of the things that I monitor closely when looking at a new acquisition and looking at making sure it ties into the firm's strategy is, what is the structure? How much capital is going to the selling business up front, the selling advisor up front, and how much is contingent on growth, client retention, and everything else? And then how well does that deal structure align with the seller's plans post-close? Yeah. One of the things folks that come to us on the, saying, well, you guys see a lot of this. Like, what's your advice to folks that are buying firms and how they should evaluate it? My advice is always to start with the seller's plans post-close and work backward from there, because your deal structure has to very closely align with their plans. If you have a seller that wants to be gone in a year due to whatever reason and they're just done, it's going to be a heavier cash up front and less contingent on growth, maybe more contingent in clawback related client retention.
Yeah.
If you have a seller that's not fully ready to step down, but they're taking some capital and stuff that you guys probably see, the deal has to be structured with opportunity and ability for them to capitalize the firm and continue to grow it and be a good partner with you. Right. So that's what I challenge folks that are looking at new acquisitions is, we don't just need to give everybody 80% of the capital up front, especially if the seller's planning to stay for 5 years.
Oh, yeah.
Maybe try half up front and the other half and allow them to participate in some of that growth, and create an earnout or a seller note that's designed to help them be incentivized to bring in new business, to grow their current client assets. So I think that's a big indicator on my side is, what does the deal structure look like? And,
Well, you mentioned clawback.
Mm-hmm.
I hate clawbacks. I hate the idea of them because it's no good for anybody. I mean, it means like certain markers weren't hit, but so on our side, we structure a deal. We'll give you more money, right? Okay. If it's I can get X, we'll give you X plus Y, but it's a little bit longer deal. It's a little bit less upfront, and there's more upside than you would otherwise have.
Right.
But that way, we really have kind of a guaranteed amount, right? Every single amount is a guaranteed amount plus an upside.
Right.
That allows us to not have to do a clawback.
Gotcha.
Right. How do you? So if you're looking at these same deals, right? How do you prep for a clawback? Because you always have to prep for worst case scenario.
Yeah.
Right. How do you? What are the things that you do inside of a deal structure, or have you seen that allows for you to be able to do that clawback without it being really, really painful for the seller?
Yeah. So first and foremost, I think defining clawback is key here. When I think at surface level, when we think of clawback, we think of money that already went to seller that we are going to take back, that seller has to like literally write a check and pay back. And I don't so much mean that. I honestly don't see a lot of those, even in traditional deals. When I say clawback, I think of, here is a deal consideration and evaluation of $10 million, just using random numbers, for example. It's $10 million. You're getting $5 million up front, and then $5 million you're going to get over the next 5 years that could either go up or down depending on client retention and or growth. So when we think of a clawback, we think of client retention or lack thereof, losing clients.
Agreed.
So when I think of a par deal that has $5 million up front and then $5 million over the next 5 years, $1 million a year, if you lose a certain percentage in that first year, that $1 million that you were going to get after year one might be $800,000. So it's really more of an earnout than it is a clawback. But in my mind, when you wrote that LOI and you offered $10 million to the seller based on these things happening, you kind of are clawing back away from that.
Yeah.
And especially as it relates to client loss. And sometimes I think the definition of clawback versus earnout is probably very defined on client loss versus market downturn, because it's the same thing with earnouts, is that first year the market might have gone down and you lost revenue that you can lose some money on. But I'm more focused on what percentage of clients came over.
Yeah.
And usually there's a buffer, 95%, 92% or something like that have to come over, because there's always that one or two clients that just, I'm not ready to sign that. I don't want to do it. I'm just going to do something else for whatever reason. Maybe they were going to before the transaction and this is just their excuse to execute on it. So I think there's always that healthy buffer there. But if you've got 80% of the clients coming over, like, there's a problem. And, I like that is held to a standard when we're lending money, that, there's a lot of the deal consideration or some part of the deal consideration at least tied to it.
Yeah, agreed.
So for owners considering growth financing in the next year, what foundational steps should they be taking now to set themselves up for success?
Sure. We have we put together 4 guidelines for most people who are looking to sell, right? Number 1 is focus on the business you want post-deal, right? You said that, right?
Yep.
Let's make sure that you have in place, and you've documented, if it's written, it'll be done, how the capital is going to be used. If I take on capital, how is it going to help our current business with the business that we want to build? Second is going to be proving organic growth. Everyone's going to ask for that. It's great to have a really cool, profitability Excel spreadsheet that shows how much you grew, but being able to show true organic growth is probably the best thing you can do.
Yep.
Right. Because it's easy to prove up. It's easy to hand to someone, and it's easy to understand. Internally, it's aligning the culture. Right.
Yeah.
So most owners don't want to say, hey, I'm going to sell. Right. They're worried about how it's going to affect the people internally. We advise people to just embrace it.
Right.
Right. Because you're going to take care of the employees. You're going to do these things. This is the reason we're taking on capital. I remember the first time we said, yeah, we're interested in that. There's always this pause, right? Are we going to now be managed by, a recent Harvard grad with an Excel spreadsheet, right? I hear that all the time.
Right.
And the answer is no. We just want to make sure that we're all prepared for what it's going to mean. So making sure that culture is rock solid.
Yep.
So that there's no surprise, right? The worst case scenario is you do a deal and you find out 15 minutes later that, who you believe was going to be your succession plan didn't understand that they were part of the equation, so they walked out. Right? That's what you want to make sure you're not doing. And then lastly, and this seems like the most obvious, it's just you have to be used to financial reporting, transparent financial reporting, right? Good, bad, it doesn't matter. I think that's what we try and let everyone know. You need to be transparent with us, because if you're having something bad or an important client leaves or there's litigation, it doesn't mean that now we're going to be, we don't want to do that deal.
Right.
It just adjusts how we approach it, because again, our focus is on the person selling and the management team thereafter.
Yeah.
It's less about the individual constraints of the business. Right?
Yeah.
Those are kind of the 4 things we set up.
That last one, we probably didn't talk about that piece enough, but I think understanding the culture of the organization and how folks are interacting with each other is huge, because you never want to get, as it relates to a loan, you never want to get into a situation that you didn't know what the outcome was going to be or what it was going to look like post close. So I think that's important. And I think message to the viewers, you said it as well, is like, we're going to find out anyways at some point.
Right.
The best thing to do when you're coming to borrow capital or take an investment is be upfront about everything. And let's say, nice, like you said, clear understanding of financial reporting, clean data room that understands, with notes about why things are the way they are, or whatever. Yeah. That's extremely helpful to us, because we're going to arrive at that conclusion anyways. But the sooner we get there, the better it's going to be for everybody.
Totally agree. Yeah. And we can do it together. Right. Yep. That's the point.
Absolutely. Perfect. Matt, well, I want to thank you so much for being here today and sharing your insights with our audience. Thank you to those who tuned in and submitted questions today. We appreciate your continued viewership. Stay tuned for more from us here at Oak Street Funding with new content, new guests. Thanks again.